Hello Sector Watchers, welcome to the show. This is the 185th episode of Sector Spotlight for Monday the 24th of July. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. It has been a few months that we spoke about the sector rotation model. So in this episode of Sector Spotlight, I'm going to do an assessment of the current state of rotation for the various sectors, as well as the four macroeconomic variables that are included in the sector rotation model, and then see if we can find the theoretical model with what's actually happening in the markets right now. Ladies and gentlemen, this is Sector Spotlight. In order to make this work, I am going to use two tools on stockcharts.com. So the first one is obviously the theoretical sector rotation model, and you can find that when you go into the charts, the various charts, and you go to perf charts. And I always use the S&P sector ETFs as the predefined group. That's interesting, but what's more interesting is what's below it, is that where you find the theoretical sector rotation model. The blue line is the economic cycle going from a full recession to an early recovery to a full recovery to an early recession and then back to a full recession, etc. And as we all know, the stock market has the tendency to lead the economic cycle by roughly 9 months. And that's the orange line that you see here. So it starts with a market bottom, bull market, market top, and then a bear market, and then it goes back into a market bottom again. So that's what we're trying to do, trying to achieve, and trying to align with what we're currently seeing in the market. One of the things, so we've got the sectors across the top. These are the sectors that are doing relatively well during these phases of the economic cycle. But what's almost equally important and very often overlooked by a lot of users of the model is the four economic indicators, the four economic metrics that are aligned with the stock market or influencing the stock market and can tell us something about the economic cycle. And these are the ones that are below here. And the second tool that I'm going to use is the public chart list, because I've set up a number of charts for these four economic indicators, as well as the 11 sector charts, the monthly charts. They're all stored in one public chart list. And you can find that chart list by going to Charts and Tools. And then on the right-hand side, you see Reports and More, and there you see Public Chart Lists. And if you click on Public Chart List, you will see a whole bunch of chart lists, and the easiest way to look for it is click on Author Name, then just scroll down to my name, the Kempenaer, and you will find this chart list. And if you click on it, you can save it to your own system and have a look at these four economic indicators, as well as the monthly charts for the economic sectors with my annotations on it. So now we have the model on the left-hand side and we have my chart list on the right-hand side, and we can go over those four economic indicators. And on every chart there are the four stages as they are described in the table below. Now the first one is the Consumer Sentiment Index and consumer expectations, consumer sentiment. And what we see here is, I think that we can qualify this move here as rising. And that would point, based on this economic metric, to an early recovery phase. So consumer expectations rising would indicate early recovery. So the second indicator that we're going to look at is industrial production. I think we can say that that is flat. This is a very long chart. It goes back to 1954. So you can see that this is almost a year of almost nothing. So that is flat. And that would indicate, that signals, that would suggest a full recovery. So the industrial production is flat which aligns with a full recovery. And then the third one that we're looking at is interest rates. Now this is probably a difficult one to call, because how are you going to look at this? I could argue that this is a very long downtrend and that we're breaking out, so we're bottoming out, which would be an early recovery. Although I do believe that this is way too long of a cycle to use that as an alignment with this cycle, that, you know, there's not a real timing element in it, but like 4 years probably is something that you would see here. So this is way too long. If you look at this move here, you could say it's rising or rising rapidly, caused by the Fed. And I think that makes the most sense because interest rates have been rising recently by the rate hikes by the Fed. So I'm going to put this indicator, interest rates, into the full recovery bucket, because I do think it's rising rapidly, certainly not falling. I don't think it's peaking, so with bottoming out being out of the question, the only one that remains is rising rapidly. And I think that justifies what we're here seeing. So that would put interest rates in full recovery as well. So we've got rising, so early recovery, full recovery, and another full recovery. And then the last one is the yield curve. And this one, it got even more inverted very recently, which is kind of surprising, but it's happening. So very clearly that indicates an early recession, which is right here, which is kind of out of whack. And somebody pointed out to me that the inversion of the yield curve, as you see it here, especially with the volatile inflation numbers and the big inflation numbers, we should adjust this yield curve for inflation. I don't have prepared that chart, but what you will see there is that it is still inverted, but a lot less than what you see right here. So still, I would put this in a flat inverted bucket, which means that our economic indicators go from early recovery, 2 in full recovery, and 1 in early recession. We're gonna take a look at the sectors in a minute, but I think there is a bit of a disconnect going on here. So where I should put it exactly is debatable, but I think I would prefer, especially with the uncertainty around the yield curve, to put it somewhere between early recovery and full recovery, possibly leaning towards full recovery. So on the chart, that would mean early recovery, full recovery, somewhere here, which would put it right in the market top, or, you know, on the way to it. And mind you, this is a long-term model, so even if we put it right here, there could still be quite some time left before we hit that market top. So let's start and take a look at the rotation and the movement of the actual sectors and see if we can put that in alignment with the sector rotation model. Now let's move over to an assessment of the rotation of the various sectors and see how and if we can align them on the sector rotation model. Now, as I told you, this is a pretty long-term model, and since we now have access to the monthly RRGs, I'm going to use the monthly tails to make an assessment of the rotations that we want to align with that sector rotation model. So this is the weekly, as you probably know it, and we can switch to monthly. And if we do that, we got a very interesting image here, because I think actually it's pretty sending a pretty strong message, pretty clear message as well. Let me get one out of the way first. I want to do them all in sequence, but I'm going to take out of the way the energy sector because it's such a distortion on the RRG. So it's way to the right, way down on the RS momentum scale, and heading at a negative heading, inside weakening, but at a very high level. So I'm going to rate the energy sector as neutral. It's still strong, but it's losing relative strength, relative momentum, I should say, with a very good opportunity for it to rotate back, but that's not happening, and it doesn't seem to be happening in the next 2 to 3 months. So I'm going to rate the energy sector as being neutral. So I remind you, energy is a neutral there, and I'm going to deselect energy and then fit the other tails, and I can get a much better image. Now let's work our way from left to right and see what's happening. So here's technology. Let's select the technology sector. Axle K, that's inside the leading quadrant and pushing further into it. So I'd say that's a pretty clear outperformer at the moment on this monthly tail. So that's a good sign for technology. If we go to discretionary, Axle Y, you can see that Axle Y is inside lagging, but it's picking up rapidly relative momentum, which is a good thing. So it's picking up. Remember, this is a very long-term chart, very long-term rotations. And when you start picking up inside lagging on the monthly, especially with such a vertical move on the RS momentum scale, once that starts to move to the right towards leading, then it becomes really strong. So I'm going to say that this is in the very early stages of being strong, as being an outperformer. So that's a good sign for discretionary as well. Now the third one is communication services. If we go to communication services, you see a similar pattern. That's inside improving. Very long tail, which indicates that there is a lot of power behind it, and it has started to pick up on the RS ratio scale, moving towards the right. So that's also a sector that is starting to outperform. Communication services getting a nice plus here. And then we have industrials. And remember, industrials, when we did the review of the monthly charts, that was one of the sectors that pushed to new all-time highs. And you can see how it already ended up inside the leading quadrant. It's starting to lose a little bit of relative momentum. But when you compare, this is a nice example actually. This is a loss of relative momentum. And compare that to the pickup of relative momentum in communication services. Obviously, this pickup in relative momentum is way stronger than what you see in the loss of relative momentum on the industrial sector. So this is actually pretty strong. It's inside leading, but the tail is shrinking, and that means that it's a very stable and strong trend. It's losing a little bit of relative momentum, but still pushing higher on the RS ratio scale. So that's an outperforming sector. It's in a relative uptrend versus the S&P 500. So also for industrials, we have a plus there. Then we go to materials. Now materials is inside the weakening quadrant, and it's starting to move towards lagging. It's either neutral or negative. Equal negative. It's not one of the outperforming sectors anymore. So that's very clear. So materials is getting a neutral reading. I'm gonna judge that as being neutral. Energy, we already had rated that as neutral. And then we go to consumer staples, XLP, and you can see how that is moving rapidly from leading into weakening and starting to move lower, to pointing to the southwest towards the lagging quadrant. And if we rate communication services and consumer discretionary as positive, we gotta be consequent here and rate staples as being negative. So we're going to put that as a underperformer. It's a relative underperformer versus the S&P 500. And if we look at healthcare, because this is where the defensive sectors are showing up, we got the same image. We got healthcare moving rapidly from leading into weakening and starting to move towards lagging. So healthcare also gets an underperformance judgment. And then we have utilities, same story, even a longer tail. You see how that long tail of utilities is going opposite of communication services. Very nice pair trade, by the way, long-term pair trade. And you see how utilities is moving rapidly towards the lagging quadrant. So that's also a relative downtrend versus the S&P 500. And then we go to, let's start with financials first. That's the first one that shows up. Same story, these defensives, financials not necessarily defensive sector, but you can see how that is slicing into the lagging quadrant from weakening. So that's also very clearly a relative downtrend versus the S&P 500. So that gets a negative right here as well. And then followed suit by real estate, or led by real estate if you wish, also rapidly moving into the lagging quadrant, positioning real estate also as a relative underperformer. So if you look at the division of those sectors, or the alignment of those sectors, it's actually there's a very clear message. You got the leading sectors right here, relative outperformance versus the S&P 500. We got materials and energy as being neutral. And the complete right-hand side here is relative underperformance. So these sectors are very clearly pointing to a bull market, coming out of a market bottom, going into a bull market. So how are we going to put that all together? And I think that the way to do it is, because it's the most important part of this model is to look for which sectors are relative outperformers. That's very clear here. The other sectors are, in my view, confirming things. And right now they're doing that very strongly. So they're telling us, this model is telling us that we are definitely not in a bear market, and we are also not at a market top. And with the four sectors that are quite clearly leading, this positions this sector rotation in the early recovery bull market type of thing. And if we go back to what we just found on the macroeconomic indicators, that was leaning a little bit more towards the full recovery, so more towards the market top. So I'm gonna put that, it's pretty arbitrarily, but it's sort of an educated guess. Especially based on the strength of those sectors that are usually doing good in a bull market, in a early recovery phase. So the fact that these sectors are doing well is pointing to the economic cycle being in a early recovery phase and putting the stock market in a bull market. Combining that with the macroeconomic indicators that are a little bit more leaning towards full recovery and market top, I'm going to put us on the way to the market top. But again, this is a long-term model. It could be months before we reach that market top. So what am I looking at? If and when we will see one of these four sectors, so technology, comm service, industrials, discretionary, starting to roll over, to become more neutral, and seeing materials and energy becoming more leading, becoming more outperformance, that's the phase, that's the situation, the event, if you wish, where I would start looking a little bit closer to a potential market top. Right now, the sector rotation model is pretty clearly telling us that we are in a bull market, in the, let's put it, the later stages of an early recovery. I hope that makes sense. When we bring it all together in this long-term chart of the S&P 500, or at least the assessments that we just made based on the leading sectors in the sector rotation model and the assessment of the economic indicators that align with that sector rotation model, I think it makes sense. Because when we look at the chart here, I think that we all agree that 2022 was a bear market. And we have come out of that. So we've started to rise. So here's your market bottom, this was your market top, this is your market bottom, and we now started to rise again. And as you can see, we're not even back to the old highs here. So I would expect if this is all, if the assessment is right and my judgment is right, then we do need to actually surpass that previous high in this new bull market. And with the current sector rotation, even if we look at the shorter term time scales, if you look at the regular charts with the upside breakouts that we're currently seeing, I think there is all to say for a continuation of the current move, with a confirmation when we take out that previous all-time high. And that completely aligns with the strength that the strong message that the sector rotation model is currently sending. So all in all, I'm remaining with a pretty bullish narrative. You can see that there's always room for a bit of decline. The last 2 months we actually had a pretty strong rally, but in the longer term picture, with the sector rotation model aligned as it is, I think that the S&P still has quite some upside potential in the next couple of months. And that wraps up Sector Spotlight for this week. Please remember, Sector Spotlight is available on demand on the Stock Chart YouTube channel, and I attempt to upload a new episode at the beginning of each week, usually on Mondays. You're welcome to share your thoughts, ideas, and or comments under the video. We really appreciate it. You can find my contact details on the screen, and we're looking forward to seeing you again next week at a new episode of Sector Spotlight. Same time, same place.